So that brings us to the step 8, the profit on option and net cost. Remember that options is not going to give you any loss, because you will only exercise the option if it is in your favor. That is, if the option is in the money, it's profitable to you. So to calculate the profit, you will compare. If I entered into this option at an exercise price, first one of 93,750, it means it's 93.75. And the closing future price, if interest rate was increasing, is 92.96. Okay, that tells me if I sold it at 93.75 and I will close it by buying at 92.96, then I have to make a profit. Therefore, that option is meant to be exercised. So if you know how to calculate that, just as we calculate the profit and the futures, you took the selling price, which is the 93.75, minus the closing price of futures, which is 92.96, multiplied by 100, multiplied by number of contract, multiplied by the tick size. And that's what you have to do for all the three. That's what you need to do for all the three exercise prices. If LIBOR decreases by 100 basis points, then you would have to be very careful here, because the option will only be exercised if it is giving you a profit. Therefore, if you look at these figures, if the LIBOR decreases by 100, the closing future price becomes 94.96, and that 94.96 is more than all the exercise prices, and as such, all of them will result into a loss. And once they are a loss, the options are not meant to be exercised. The options are not meant to be exercised. So that is how you calculate the loss. But in the examination room, there's no need for you to calculate the loss. You just tell the examiner the option will be left to lapse because it is just out of the money. Okay. So if you look at the net interest cost using the option, for each exercise price, okay, if interest rate is increasing or interest rate is decreasing. So I've done 93,750, 9400, 94250. Then if interest rate is decreasing, 93,750, 94 and 94,250. So the current cash market cost is what we calculated. If the interest rate is increasing, we get 750 each. If interest rate is decreasing, we get 550 each. Then option require payment of premiums. Option require payment of premium, and therefore, what were the premiums? When it is 93,750 exercise price, it was 45. When it is 94 exercise price, it became 16,800, and then 94,250, it was 30,000. So that is what we put in there. Then that premium obviously is a cost to you, so you will pay that in addition to the interest that you have to pay in the main market that you're going to borrow. Then did the option give you any profit? You don't think about a loss here because you wouldn't exercise. So when the interest rate increased, you made a profit on the options, and those profit will be a deduction to the interest that you would have to pay. When the interest rate decreased, we made a loss, and that meant the option will not be exercised, and therefore we do not have to bring those losses there. So when you sum up all of that, it will give you your net interest cost. But remember, the profit is being deducted out of the sum of the interest cost and the premium. Okay, and the effective rates are done. So for options, just as features, there will be the need for you to know what date contract. Are you using a put option that will give you the right to sell, or a call option that will give you the right to buy? The number of contracts, and then here the number of contracts should be calculated the same basis as you calculated for the features, because the option is on the features contract. Okay, and then you calculate the premium, because options will demand you to pay the premium in order to have the right. Okay, and then you calculate the profit or loss. If it's a loss, you wouldn't exercise, and therefore you don't have to bother yourself with it, and you calculate the net outcome.